Okay, so now we're going on to problem 3. And problem 3 continues with problem 1, which I provided problem 1 here. This is problem 1. Problem 3 says, same as one above, except assume that the fair market value of Lime's building is $700,000 and that no money is owed by Lime. Also assume there's a $225,000 liability associated with Lemon's building that Lime assumes. Finally, Lemon pays Lime $125,000. As a reminder, this series of problems, the Lemon and Lime, you should always consider, again, the earlier problem because it builds on one another. Okay, so going back to problem 1, we're focusing on Lemon, and that's the same in problem 3. We're also determining the realized gain or loss, the recognized gain or loss, and the basis of the new building received. So we have to answer those questions. And you'll see I've already listed out for you and created charts for the realized gain or loss, the recognized gain or loss, and the new basis of the building that's going to be received by Lemon. Okay, so let's start with realized gain or loss. Remember, property transactions, that's your first rule. Doesn't matter if it's a sale or exchange, city comes and condemns property and gives you proceeds, or seizes your property for eminent domain, they give you money so they can build a highway through it. That's considered an event where you have to record the realized gain or loss, just like a sale or exchange is. Here we've got an exchange because Lemon and Lime are trading buildings. So we go into our realized gain or loss, and as you all know, amount realized minus adjusted basis equals the realized gain or loss. So amount realized is where we start. Our formula is actual cash plus constructive cash plus the fair market value of non-cash property minus selling expenses. You'll see I don't have selling expenses on here, and that's because this series of problem, we're not going to worry about that. But obviously in practice, you would have to subtract those out. Okay, so actual cash. Let's just go through, because amount realized is all about what is Lemon getting. Looking at the problem again, same as 1. So in 1, remember what happened. Lemon and Lime traded buildings. Lemon took on Lime's debt. Nothing else. In 3, we're told, okay, same as that scenario, except the fair market value of Lime's building is now $700,000, and Lime does not have a liability that Lemon takes on. That's obviously extremely important. So in problem 1, we saw Lemon had constructive cash paid because Lemon took on Lime's liability, but in problem 3, we don't have that anymore. Lemon is not taking on Lime's liability. Very important. Keep that in mind for when we determine the basis of what's for realized gain or loss calculation. We're told also assume the $225,000 liability associated with Lemon's building that Lime assumes. So this is the opposite of 1. Lemon has a liability, right? It's Lemon's liability, and Lime assumes it. So Lime is taking this on. So this is liability relief. So we're going to put in constructive cash received by Lemon, $225,000. Finally, Lemon pays Lime $125,000. That is not receipt. So that is not amount realized. That is going to be under the adjusted basis portion of the realized gain or loss because it's going out. It's an outflow. So there's no actual cash in this problem received, only paid. There's constructive cash received. We just recorded that. And then the fair market value of non-cash property is, of course, the building that Lemon receives from Lime, which has a value of $700,000. So we can now calculate our amount realized. 225 plus 700, we've got $925,000 amount realized. Let's go to the adjusted basis. So the adjusted basis is the adjusted basis of all property given up. I always start the adjusted basis of the building that Lemon is giving up. That's given to us in problem 1, $500,000. We're also told there's no money owed by Lime. So Lemon is not taking on any liabilities. So Lemon is not paying or taking on any liabilities, so that's going to be 0. We are told Lemon pays Lime $125,000 of cash. So actual cash paid by Lemon is $125,000. So the adjusted basis added up is $625,000. That gives us a realized gain or loss of $300,000. So we've completed step 1, calculate the realized gain or loss. Now we go to step 2, the recognized gain or loss. This transaction qualifies for non-recognition under Section 1031, like-kind exchange. Why? Because Lemon owned a building used in business and is getting a building used in business, and they qualify for a like-kind exchange because it's real property used in business or investment, and on the other side, real property used for business or investment. However, if we look at our diagram, our realized gain or loss chart, whatever you want to call it, table, guess what? Lemon's got some boot received. Anytime you got boot received, you got to turn on the boot issue. Special rule for boot. The lesser of realized gain or the amount of boot, but it's net boot. The next question you always ask when you have boot received is, hey, is there any boot paid? Yes. $125,000 of actual cash. So the rule is the following. There's 2 sets of rules here. And keep these rules in mind for later problems, because I'm not going to write them out, but I will remind you of them, but I'm not going to write them out. This is where we talk about the rules. So when it comes to netting boot, the general rule is that, don't want to be that general or that specific. Boot received can be offset by boot paid. However, there's an exception. And the exception lies specifically in liabilities taken on. Only applies to liabilities taken on. Constructive cash paid. So liabilities taken on can only reduce liability relief boot. Can only reduce liability relief boot. Now, we do not have any liabilities taken on. We have actual cash paid, not constructive cash paid. So this exception does not apply here. It does apply to the general rule. I'm sorry, the general rule does apply. That's what I should say, sorry. Because we have actual money taken on. So if we apply the general rule, that's easy. We just take boot received minus boot paid. I'll erase this X here because I don't want to confuse you. Although that still does apply to that previous concept. So the boot received here, there's only one item of boot here. It's the liability relief of $225,000. Minus boot paid, there's actual cash paid. Actual cash boot paid of $125,000. We've got net boot of $100,000. $100,000. All right. This one isn't too bad. When you got the special rule that applies, the exception, that's when things get a little interesting. And we'll see an example later on of that. So keep watching the later problems and you'll see that. But let's continue. So we've got our net boot, $100,000. We've got our realized gain, $300,000. So the lesser of $300,000, $100,000, of course, is $100,000, and that's going to be our recognized gain or loss on this transaction. $100,000. Now, before we move to step 3, remember, as we did in earlier videos, we calculate the suspended gain or loss. Suspended gain or loss is number 1 minus number 2. Number 1, of course, the realized gain or loss is $300,000 minus number 2, the recognized gain or loss of $100,000. The suspended gain is $200,000. Keep that in mind. Okay, so now we move on to step 3, determining the new basis. So we got the adjusted basis and the old. So the adjusted basis in the old, we can use the number right here, $500,000. Plus money paid. So we look at our table from the realized gain or loss calculation. We've got actual money paid of $125,000. So look at the lower row. That's right here, right? The lower row, the adjusted basis row, that's where you'll find these items. There's no constructive money paid, right? Minus money received. We got $225,000 of constructive money received. There's no there's no actual money received. Plus gain recognized. Gain recognized here is $100,000. It'd be minus loss recognized, but we do not have loss recognized, so we're not going to worry about that. So we go ahead and we calculate our basis. Our basis in the new is going to be $500,000. So before we finish the problem, we can check our work. We check our work. We assume, hypothetically, the next day, and this doesn't actually happen, Lemon sells the new building that Lemon receives for the fair market value at the date of the exchange, which we're told in the problem is $700,000. We ignore everything else. Just use the fair market value. Amount realized, $700,000, minus, you subtract away the adjusted basis you just calculated of $500,000. That gives you a $200,000 realized and recognized gain. It's recognized because you're selling it, hypothetically selling it for cash. And there's no non-recognition rule that applies when you've got a sale for cash. So we got $200,000 realized recognized gain that would be recognized if you did actually sell it for $700, and you got suspended gain of $200, boom, equals. So make sure that the gain stays there. So please continue on watching and watch the other videos on this specific topic.